we start with the class, and as usually we start by revising what was important that we did in the last class. So, I gave you this chart, and I told you this is a survey of chief financial officers. But you can look at it in a different way. You can look at these numbers as the probability that your boss will ask you something about these methods. I mean, people, please stop talking. You know, I might look, you know, like a hobbit, but but it doesn't mean that I can not turn into but it doesn't mean that I cannot turn into my evil colleague that teaches accounting or whatever. I mean, I can look as evil as he looks. So please keep quiet. I mean, the fact that I'm friendly doesn't mean that you are encouraged to talk in my class. Okay? So please keep quiet. I mean, Frodo can become bad. Yeah, this is recorded, unfortunately. I forgot to press the mute button, I'm sorry. So, this is the probability that your boss will ask you something about this method. So the net present value is very important. There is 75% chance that your boss will ask you to do something with the net present value. The second one, also very, very important, even more important than net present value, is the internal rate of return. So, what did we say in the last class? We said, if you have a cash flow stream like this one, that starts at minus 4,000, you invest 4,000 and then you get 2,000 and 4,000 in the next 2 years. We said the internal rate of return is the discount rate that will make this net present value, the net present value of this cash flow stream equal to 0. So in this case it was 28.08%, and if you discount this cash flow stream with this rate, you would get the net present value equal to 0. And we said this is the rate actually that you earn annually by investing into this project. So let me try to give you a slightly different interpretation of the same example that will hopefully shed a different light on the concept of the internal rate of return. So, imagine that you have exactly the same problem. You invest 4,000, you get 2,000 and 4,000 back in next 2 years. But now, I don't ask you what is the internal rate of return, but I ask you, would you do this project? Would you invest this 4,000 in exchange to get 2,000 and 4,000 back later? Now, let's pretend we know nothing about the internal rate of return. The only thing that we know is the net present value. Then if you used the net present value to make a decision about this investment, you would say the following. Okay, let's calculate the net present value. And if the net present value is positive, I would do this project. If the net present value is negative, I would not do this project. So your answer to this question, would you do this project, would crucially depend on the interest rate that you will use to discount this cash flow stream. So what did we say? Which interest rate do you use when you discount this cash flow stream? The idea is you use the interest rate that alternative similarly risky project would give you. So something similarly risky gives you, let's say, 40%. Let's say that this is as risky as something that gives you 40%. Then in this case, you would not do this project because this project would then have a net present value of negative. It would be a negative net present value of minus 530. On the other hand, if this project was less risky, let's say 25%, then, well, you would do this project because then this project would have a positive net present value. Okay? Now the question is, would you do this project if the interest rate of that the similarly risky project was offering you was actually 28.08%? Then you would be indifferent. You would not care whether you invest into this project or in another project that is offering you 28.08%. So this kind of gives you a different perspective on what internal rate of return is. It tells you how much this project earns. So you would invest into this project if this project was earning more than alternatively risky project. So this project earns internal rate of return rate. So you would do this project if the internal rate of return was higher than what the alternatively risky project offers you. So if the alternatively risky project offers you 25%, then your internal rate of return is actually higher than this project. And you see, in this case, the net present value is positive. If the internal rate of return is actually smaller than what alternatively risky project offers you, then you don't do this project. But we said it's not so straightforward to interpret internal rate of return. It's not so straightforward. Why? First, you need to make distinction between two cases when you have lending and borrowing. Think about it in the following way. If you go to a bank today and you ask them, okay, I need a mortgage for my house. Which rate do you offer me? Do you prefer higher or lower rate in this case? Lower rate. So you prefer lower rate when you're actually taking money from somebody. And when you invest your money in a bank, do you prefer that the bank gives you higher or the lower rate? Higher, obviously. So you have to think about it. I mean, this is not a big pitfall, because by thinking about it, you can say, actually, it's just that the internal rate of return rule is not so simple. It's not, I prefer the higher rate. Yes, you prefer the higher rate, but not always. When you are borrowing money, you prefer the lower rate. Now, problem number 2 with the internal rate of return, we said, is that same cash flow stream might have multiple internal rates of returns. And we said, as many as switches in sign we have, as many internal rates of the return a cash flow stream will have. So if cash flow stream is negative, then positive, then again negative, it will have two solutions. It will have two internal rates of return. If it has multiple switches inside, if it switches sign 10 times over the life of the project, it will have 10 solutions. And sometimes it's very difficult to figure out what is the solution that you should care about. And programs like Excel or your financial calculator will always give you just one solution. They will not give you, okay, these are the 10 solutions. So you should be careful when you are calculating something with the internal rate of return. Moreover, you know, in the Excel function internal rate of return, you can, beside providing it with the cash flow stream as an argument, you can say comma and then say your guess. What is your guess that the internal rate of return is? If the internal rate of if the project has multiple internal rates of return, depending on the guess, you might get different solutions. Actually, the solution that Excel offers you will be the one closer to your guess. So this is a difficult problem to deal with, these multiple rates of return. You have to be really careful, because as I give you an example with 11% and minus 44%, it's very different. It's very, very different, and these are the things that you can lose your job for. Your boss tells you what is the internal rate of return, and you tell him 11%, and it turns out that it's minus 44. So instead of earning money, he's losing money. Well, this is a difficult problem. The third problem, undefined internal rate of return, we said this is not really a problem, because internal rate of return is not defined only for strictly positive cash flow streams. So when there is no investment. Everybody loves these cash flow streams, so you are not really faced with this problem in real life. Then we said problem number 4, if you have mutually exclusive projects, for example, if you can build only one of these two projects, and only one at a time, not multiple times project 1, not multiple times project 2. You can choose only between project A and project B. If they are of a different size, internal rate of return might be misleading. It's not always misleading, but sometimes it is. I gave you the example in the last class when it's really misleading. And finally, problem number 5, for which there is no fix. Guys, Could you please stop? So problem number 5 is that the internal rate of return can never take into account the term structure of interest rate. It can never take into account the fact that if you invest your money for 1 year, you will get a different annual rate than if you invest your money for 2 years. It assumes basically that all funds are reinvested at the internal rate of return, no matter for which period of time you invest this money. If you invest for 2 years, for 1 year, the internal rate of return always assumes that the rate is the same. And this cannot be fixed. While with the internal rate of, while with the net present value, it's really simple. You just discount different cash flow streams with different annual rates. It's very simple for net present value and unfixable for the internal rate of return. So we said, okay, very high probability that somebody will ask you about net present value. And this is good, because net present value is very simple to interpret. It's always the positive is the good. With the internal rate of return, there are some problems, and there is very high probability that somebody will ask you about it. So understand these problems, because you might lose your job if you do it wrongly. Payback rule, we said, even though it's a very high chance that somebody will ask you about it, it's a very silly rule. It's a rule that disregards the time value of money and disregards all the cash flow streams after the payback period. So this is, we said, if the project, when the project pay backs the initial investment just by adding numbers without taking care about their present values, about the time value of money. And we said this is a very bad rule, and it can be very, very, very misleading. Book rate of return, this is just the division of two random accounting numbers, and it's not related directly to performance, and it can be really misleading, so you are encouraged to use it. Profitability index is used to determine in which projects to invest. If you have a budget constraint, then you cannot invest in all projects. And this is a good rule. I mean, this rule takes into account the present value of money and stuff like that. This is just the net present, this is just a variation of the present value thing. Okay. Then we said, when you want to calculate the price or the value or to value some investment, the only relevant thing is a cash flow stream. So whenever I give you some text of exercise in these examples in my slides, I always try to make this diagram, how this looks in terms of cash flows, because this is the only thing that matters. I mean, whether this is a machine or this is a car or this is a house, I don't care. The only thing that matters is a cash flow stream. Now, what is also important is that you are estimating these cash flow streams on an incremental basis. So what does it mean? I gave you an example of the Sony Corporation. If the Sony Corporation wants to build Sony PlayStation 4, they don't care about cash flow stream of Sony PlayStation 4 alone. What they care about is how their total cash flow stream of the company will change if they do this project. I said, if you create the Sony PlayStation 4, this will change the cash flow stream generated by the Sony PlayStation 3 because it will cannibalize the sales. But it will also create some incidental effects. You will also sell less of, I don't know, peripheral things for Sony PlayStation 3. You will sell less games for Sony PlayStation 3. You will also maybe start selling some better TV sets because Sony PlayStation 4 will support some new resolution or whatever. So you should take all this into account when you are creating a cash flow stream that you want to, when you are valuing a project. Also, you should forget about these sunk costs. This is one of the most common mistakes that people make. Only future cash flow streams are important. Nothing else but the future cash flow streams. So what happened in the past stays in the past. Whenever I draw you a cash flow stream, I make a drawing starting at year 0, starting today and into the future. We don't care about things that happen in the past. In a sense, we care about if you borrowed money in the past, so you will have to repay it in the future. But we don't care about the cash flow streams from the past. You know, borrowed money in the past means the cash flow stream in the future. So the only thing that we care about is the cash flow stream in the future. Past does not matter. We said we should also take care about these overhead costs. Like I'm teaching now, there is electricity here, there is this overhead projector burning this lamp that will die probably in 1,000 hours or so. Somebody has to pay for these kind of things. It's also part of our costs of this class come into these kind of things. Also, we said treat inflation consistently. What does it mean? It means discount nominal cash flow streams with nominal rates and real cash flow streams with real rates. You have an example in previous class. Then we said, let's try to solve a problem like this. Did we have last time class on Thursday or on Friday? Okay, then we did just a little bit of this. On Friday class, I managed to explain this from the beginning to an end. In Thursday class, I did not, so I will try my best to do it now. Okay, so imagine you have to choose between the two following investments. You have a machine A or machine B. Machine A is a more expensive machine. Machine B is cheaper machine. For this one, you need to pay, for machine A, you need to pay 15 today, and it will cost you to maintain 5 per year. For machine B, you have to pay less today. It's a cheaper machine. You have to pay 10, and it will cost you 6 per year, but it won't last for the same period of time. It will last shorter period of time. Now, the question is, which machine do you buy for your factory? This one has a higher net present value. If you calculate the present value, you will get 28.37. This one has a present value of 21. Which one do you buy? Yes, this one is cheaper, but it doesn't mean that you want to buy this one because it lasts less. It lasts 1 year less than the machine A. So how do you answer this question? In the book, they will give you one methodology how to do it, but this methodology is a bit problematic, and in every book they will give you this methodology and it has the same problem. They will just tell you, divide the net present value with some annuity factor. Could you keep the noise level down? So, how do you do it? Well, this is the way how you can do it. So, this is the cash flow stream of machine A. You pay 15. I mean, in our notation, this should be down because these are costs in a sense. But we can work with it like this because everything is cost. So you have to pay 15 in year 0 today. You have to pay 5 in a year from now, in 2 years from now, and in 3 years from now. And we know that the present value of this cash flow stream is 28.37. So what does it mean? It means that I'm indifferent between this cash flow 15,555 and $28.37 today. But now what I want to find is, okay, can I calculate how much does this machine cost me per year? If this is the total present value of the machine, one naive thinking would be, okay, this is $28.37 today. If I divide this by 4, this will be how much this machine costs me per year in a sense. If I divide this by 4. So let's pretend that this is 28 and not 28.37. So this would be 7 per year. But imagine if this was 7 per year, that would mean that you are assuming that the $7 today is the same thing as the $7 in a year from now, because then you would say 7 plus 7 plus 7 plus 7 is 28. But this is not the case. We need to find this cash flow stream that has a present value of $28.37 today. So we need to find a C that will give us $28.37 today. So what is this C equal to? How do we do it? Well, this is how we do it. So $28.37 today needs to be equal to this thing over here. So, and this cash flow stream CCCC is equal to basically two cash flow streams. This cash flow stream plus this cash flow stream. This is exactly the same thing. If you own these two cash flow streams on the right-hand side of the equality, and if you hold this cash flow stream, it's the same thing. You own the same thing. Now, what is the present value of this thing? This is an annuity. Cash flow stream that starts in a year from now and for some period of time pays constant payments is... I'm sorry guys, could you stop the discussion? I mean, it's ridiculous. This is going to be recorded. You don't have to attend this class. It's not obligatory. So this is the annuity. So what's the present value of the annuity? We have derived this formula. This is the present value of the annuity. And this annuity ends in year 3. So T is equal to 3. What is the present value of this cash flow stream at the right-hand side? Well, this is just C. This is C dollars today. So we want to find C that will make these two present values equal to 28.37. So we just add these things together. This has to be 28.37. So we solve for C. Take C in front of the parentheses, divide by everything in the parentheses, plug in the numbers, where R is 6%, this T is equal to 3, and you get 7.72. So what does it mean? It means that $28.37 today, this is today, is actually the same thing as 7.72 in these, like 7.72 today, in a year from now, in 2 years from now, in 3 years from now. And you can see that this is actually, if you discount it with 6%, this will give you exactly 28.37. So what does it mean? This means that this machine costs you 7.72 per year. This is for the expensive machine. Now, how do we do it for the cheap machine? For the cheap machine, we repeat analogous procedure. We say, this is the cash flow stream of the cheap machine. We can calculate the present value. That means that we are indifferent between this cash flow stream and $21 today. Now let's find a cash flow stream that will not live as the expensive machine, but number of periods as the cheap machine. And now let's see, what C do I need to make the present value of this cash flow stream equal to 21? What is this C? How do we do it? Again, the same thing. This cash flow stream, so 21 today, must be also this cash flow stream has to generate 21 today. So this cash flow stream on the left-hand side has to be equal to this annuity plus C dollars today. So present value of the annuity is given by this equation. Present value of C dollars today is C dollars today. So we just say 21 is equal to this thing. But now T is not 3 anymore, but 2, because this annuity stops paying in year 2. The last payment is in year 2. So we solve this equation, and we get 7.41. So what does this mean? That means that $21 today is exactly the same thing as 7.41 paid today in a year from now and in 2 years from now. So we get that this machine costs you 7.41 per year. Okay? And the expensive one costs you 7.72 per year. Therefore, you buy the cheap one because it's cheaper per year.
I still have a question, but the expensive machine lasts for 4 years, so, and the cheap one only for 3 years. So if the cheap one actually stops working, you have to buy a new one.
Yes, exactly, but it will cost you less per year. You are assuming that this machine will work. Okay? Okay. We are done now with the revising of what we have done so far. Now we move to something really, really important, to really important part, an interesting part of this class. We are going to talk about the risk. How do we measure risk? This is one of the basic things in finance. How do you measure risk? What's the measure of risk? So we will talk about measuring of risk of companies and measuring risk of portfolios of companies when you invest into many companies. So how do you do that? Well, before we actually do that, let's talk about one lottery, one quiz. And this quiz, I have seen it in every country that I have lived in. And I have lived in quite a few. And it's very popular. And usually it goes like that. You win some money in the quiz. Let's say you win $5. And then they ask you, okay, you can keep this $5 or you can gamble and win $10 with probability 1/2 or $0 with the probability of 1/2. So the height of these bars tells you what's the probability. In this case, this is $5 for sure, probability 1. Or you can change this for $10 with probability 1/2 and $0 with the probability of 1/2. Now, what do you choose, guys? Who would gamble in this case? I mean, some people would gamble, obviously. But if I ask those people that say that they would gamble, the same thing, just I add M downstairs. So now it's not anymore $5, but 5 million. Would you gamble with 5 million like this? Well, I see no hands currently. And this is with a reason. And the reason is we as a species, people as a kind, as a human, we are risk averse. Usually most of us are risk averse. Everybody is risk averse. And I will now try to somehow explain, to give you more arguments for this thing, beside this argument. Now, in your class of how it's called, mathematics for economists, you have probably talked about the utility function. So now, what is the utility function? The utility function tries to tell you how happy you are if you eat cookies. This is the essence. It tells you, if you eat 2 cookies, you are happy 1 unit of happiness, let's say, if this is your utility function. You know, some people try to put money inside the utility function. There are models that say, okay, your happiness depends on money. But this is usually a bad thing, because, you know, money is a piece of paper, and pieces of paper don't make you happy usually. Because this piece of paper today might buy you 2 cookies, and tomorrow they might buy you 4 cookies. So it depends on the inflation and many things. So people usually put something inside which is called C. And this C comes from the consumption good. It comes from the consumption good. I call it cookies. Some people call it consumption good. But okay, so you eat 2 cookies, you are happy 1 unit of happiness. So 2 cookies per unit of happiness if this red line is your utility function. So what would happen if you eat 0 cookies? Well, you are really not happy. You are not happy at all. So how happy you are if you eat 10 cookies? You are happy 5 units of happiness. You are 5 times more happy than if you eat 2 cookies. Exactly 5 times more happy than if you eat 2 cookies. Now, how happy you are if you eat 5 cookies in this case? You are happy 2.5 units of happiness. Now, let's try to think about this and see what do we learn from this example. What do we learn from this example, and how does it relate to the quiz that I have given you? Imagine that actually in the quiz you were winning cookies. So you can win 5 cookies for sure, or you can win 10 cookies with probability 1/2 and 0 cookies with the probability 1/2. Okay? So if you win 5 cookies for sure, you are happy 2.5 units of happiness. Now, if this is what described your happiness, this utility function, then how happy would you be if you win 10 cookies with probability 1/2 and 0 cookies with probability 1/2? Then you would end up with 1/2 times of what the level of happiness that you get if you eat 10 cookies, plus 1/2 the level of happiness that you would get if you eat 0 cookies. That is again 2.5. So in this case, if this was your utility function, you would be risk neutral. You wouldn't matter. Do I gamble or not? It doesn't matter. I'm happy. I'm happy exactly the same. I'm happy 2.5 units of happiness. But as we said, this is not good, because in reality people do not like to gamble and not to gamble in the same way. So I prefer the 5 for sure compared to 10 with probability 1/2 and 0 with the probability of 1/2. Now, let's see a bit different utility function. Let's say this utility function, which is square root of c. Now, it's not really important that this is square root of c. What is important is that this utility function is concave. You know what is a concave function. So this is a concave function. So let's see what's happening with our lottery experiment or our quiz experiment with this utility function, if this was the utility function that was describing us well. Well, what happens is the following. How much do you get happiness if you eat 0? You get 0 happiness. You are not happy. You get square root of 0. This is 0. What if you won 10 cookies in the quiz? How much happy you are? Well, you are happy square root of 10. That's 3.16. Now, how happy you are if you get 5 cookies? You are happy square root of 5. This is 2.23. Okay? So, now I ask you, how much do you like to get 5 for sure? Well, it makes you 2.23 units of happiness happy. Now, how much do you like to get 10 with the probability of 1/2 and 0 with the probability of 1/2? Well, 1/2 times what you get when you eat 10 cookies, 1/2 times what you get when you eat 0 cookies, this is 1.58. And you see, this is much less than what you get when you eat 5 cookies. So this concave utility function tells us we prefer 5 for sure than 10 with probability 1/2 and 0 with the probability 1/2. But note that this also implies some very important concepts. And this is why one of the reasons why I believe that people in general are risk averse. They don't like risk. Imagine that you are really poor. What does it mean? You have 0 cookies. You have nothing. And if I give you 1 cookie, you will be how much more happy? Well, you will be more happy 1 unit of happiness. Okay? So increase from 0 to 1 would make you 1 unit of happiness more happy. But now imagine that you are rich. You have 10 cookies. If I give you 1 cookie more, you will be just slightly bit more happy, just a little bit more happy than before. Because square root of 11 is almost the same as the square root of 10. It's almost the same thing. You are just a little bit more happy. But you know that when you're eating cookies. When you eat 10 cookies, then the 11th cookie, I mean, what's the difference? But now imagine that one of these guys that, they like these extreme sports and stuff. They think that they are risk-loving. They love risk. They think that they love risk. But if they love risk, that means that this is their utility function. It's convex. Let's say c to the square. I mean, usually when you describe people, you don't use square root of c. There are some concave functions that people have done many experiments to test actually what is the utility function that would describe people well. A lot of experimental findings support some forms of utility function. It's not square root of c. It's concave, but it's not square root of c. I use square root of c because it's easy to use. Now, let's assume that people are actually risk-loving. What does it mean? In our example with the lottery, you would get 0 to the square. This is 0. For 10 cookies, you would get 100 units of happiness. For 5 cookies, you would get 25 units of happiness. And so basically, if I give you 5 for sure, you get 25. You are happy 25. If you get 1/2 probability 10 cookies, 1/2 probability 0 cookies, you are happy 50. So you are happier if you gamble than if you don't gamble. But note also that this example assumes something that really does not make any sense, which is the following. Let's say that you are really poor. You have 0 cookies. I give you 1 cookie. You will be happy like 1 unit of happiness more, because utility of 0 is 0, utility of 1 is 1, u to the square. So you are 1 unit of happiness more happy. But now imagine, you have 10 cookies. I give you 1 cookie more. That means that you go from 100 units of happiness to 121 units of happiness. So 1 cookie, if you are rich, increases your happiness by like 21 units of happiness, and here, when you are poor, it increases your happiness just by 1 unit. It doesn't make any sense. So people that think that they love risk, they usually don't understand the concept of risk, actually. It's not that they like risk. Okay, let's get back to our lottery. So this chart tells us what? In this game, probability of winning 100% is 1/2, and losing 100% is 1/2. And in this game, you just do not. You just keep what you have. Your return is 0 in a sense. You have 5 million, you end up with 5 million. Okay? Now, let's try move from this extreme example of gambling to investing into stock market, which is also kind of a gambling. And let's observe this chart. Now, what is this chart telling you? Unlike in the previous case where you could lose 100% with probability 1/2 and win 100% with the probability of 1/2, here you have everything in between. So there is a very small probability that you will lose something between 50 and 40%, and there is a very low probability that you will win something between 50 and 40%, and the highest probability is somewhere in between, okay? You understand what this chart tells? And actually, this chart was constructed by observing some stock. You take the historical data and you count how many times did you lose between 50 and 40% by investing into this stock. How many times did you win between 50 and 40% by investing in this stock. And for each of these bins, as they are called, for each of these intervals, you check how frequently you were losing or winning this amount of money on the annual basis. Now, this is just some, this is not a discrete case where you either win or lose 100%. This is something in between. You can win 50, you can win 40 with some low probability, but most often you will get something in between. Now, let's observe another company. This is the data, real data, from another company. Let's say this is IBM, and let's say that this is Procter & Gamble. So what do we learn from this chart? Well, in this case, sometimes you will lose something between 30 and 25, but you will never lose 50 or 45%. So in that respect, let's observe these two cases like in the lottery case. This is more safe and this is more risky. Why? Because you see, here you will never lose between 50 and 40%. And here you will never win between 50 and 40%. Like in the lottery, you get 5 for sure. This is closer to 5 for sure than this one, obviously. You see? This is just the same thing as this quiz. Just it's not a clear-cut case. You lose 100, you win 100, or it's not you win 5 for sure. You get something between minus 30 and plus 30, and here you get something between minus 50 plus 50. So if you have a concave utility function, if these things are centered around the same thing, let's say that they are centered around exactly the same thing, then if you have a concave utility function, this one will make you more happy. Why? Because it will move you less from the extremes, and you don't like extreme. You don't like -100 and 0. You prefer thing in the middle. We saw if your utility is concave, this is what you prefer. Okay? And now, observe the shape of this distribution. This is actually generated by the real data. Now observe that this looks very much like some bell-shaped curve that you have seen many times in your statistics class. It looks like a normal distribution. And this normal distribution, in order to be able to draw this red line, you need to know only two parameters. This is the big advantage of this distribution. And these two parameters are mean and the standard deviation. And we know that at 1/2 of the height of this distribution, this line will be standard deviation of this distribution. If you observe the other distribution, it will also have a mean and the standard deviation. And we said, let's assume that the means are exactly the same. Let's assume that the means are exactly the same. Then obviously the only difference between these two distributions is actually standard deviation. And you can see that the standard deviation of the distribution of the left is much larger than the standard deviation of the distribution on the right. And we said, if we are risk averse, we don't like risk, we prefer this one with the smaller standard deviation. We prefer the brownish one compared to the blue one. Okay? Therefore, this is a good indication that a good measure of risk could be a standard deviation of a distribution. And if we observe stocks, we can observe that actually all stocks are somehow normally distributed. Normal distribution is a very good approximation of the returns of the stocks. What do I mean by that? I mean that normal distribution describes well at what kind of returns you will get with what probability of a stock. There are some distributions that describe that better, like a t-distribution, but this is just a small, tiny detail, and it's out of the scope of this class. You will hear about it in some other classes. But the idea here is that the normal distribution is a good measure of stock returns, and the standard deviation is what measures risk, captures the phenomena of a risk well. And now try to think about it as with lotteries. You know, the totally safe lottery has no standard deviation. It's 0 basically, because for sure you will always get 5. In the other case, standard deviation is pretty high because the difference between the sum of the square deviations from the mean, which is a measure of variance, you take a square root, you will get some number. So, what is the variance? Variance is average value of a square deviation from a mean. And what is the standard deviation? It's a square root of variance. Okay, so these are going to be somehow our measures of risk in this class. In the next class, we will refine these things. We will improve upon this. Now, let's observe some historical data. I have downloaded this 2 days ago, and this data goes from 1926 to 2010. And the green line tells you what were the annual returns if you invested in the US stocks. So what does it mean? If you were investing in the US stocks in, for example, 1928, which is the time of the big recession, you would lose 45% of your wealth over 1 year period. Now, observe the more recent dates. So this is 2008, this big kink at the end. So you would lose around 35% of your wealth in 2008 if you were investing naively into stocks. But you would also win more than 30% in 2009. And in 2010, you would also earn around 20%. And see, the blue line are the bonds. And you can see that bonds compared to stocks, they almost don't move when you compare them to stocks. But when you observe bonds alone, this is like a zoom in. You see, they go basically from 0 to 15% per year. Now, this is the same chart. I mean, you see, from 0 to 15%. It's just a different scale. It's just that this 15% looks so tiny compared to the jumps of 60% that you observe with the stocks. Now somebody will tell you, yeah, in the last couple of years it was really tough. It's the end of the capitalism as we know it. And if you observe this chart, I mean, this is just a random stuff. I mean, the last 2 years don't look any special whatsoever. But we will see that they are actually quite special. Okay. But you see, if you observe the previous chart, we have learned that stocks jump up and down much more than bonds. So if you are a risk-averse person, you prefer less jumping up and down, left and right on our scale. Why? Because you prefer getting 5 for sure than 10 with some probability and 0 with some probability. So you prefer something in the middle than two things around, in a sense, because you are risk averse. So in order for you to hold stocks, you need to earn some premium for that. You need to earn more in order to buy stocks because they jump more up and down. And actually in this chart, you can see if you invested $1 in 1926 in stocks, this is what would happen. The green line describes what would happen with your investment. If you invested in 1926 $1 into bonds, the blue line tells you what would happen. Actually, you cannot even see it in this chart because stocks will earn you so much more. So, if you observe on a log scale, so what is this? This is the same chart from the before, but y-axis does not go 0, 1, 2, 3, 4, 5. It's not a linear scale. It's a log scale. It goes 0, 1, 10, 100, 1,000, 10,000. So on the log scale, you can actually see that by investing $1 into bonds, you would end up earning like, I don't know, $20 after almost 100 years. And just adjust that to inflation. You would earn probably nothing. Now, if you invest $1, if you invested $1 in 1926 into stocks, you would end up with more than $2,000, which is a big difference. And why are stocks paying so much more? Because they are more risky. We see they jump up and down a lot, and we don't like that. Now, what I have showed you so far were annual returns. Now let's see how it looks on a daily level. These are daily returns. These are daily bond yields and daily stock returns. What you can observe on this chart are a couple of things. First, if you observe the stocks chart, you will see that you have periods of high volatility and periods of low volatility. You see, here it's very volatile, then it's calm. Then again it gets more volatile, then it's again calm. Then it again gets more volatile, then it's less volatile, etc. And this chart goes from 1963 till 2011. So this is a very recent date. And with bonds, you can observe that, bond yield goes from 0 to, 0.06 per day. And with stocks, you see, you had days in the year 2008 where you could lose like 10% of your wealth in just one day. Overnight, you lose 10% of all your wealth. But you see, in 2008, you could also win like more than 10% in one day. So it was really crazy market these days. And this was daily. And again, here 2008 does not look too much special. It looks more volatile than previous periods, but not so dramatically. I mean, it looks pretty different, but not so dramatically. But one thing that you can observe that is really, really different is actually bond returns. You see, in 2008, they go basically to zero. They just go down. They pay nothing. And if you have done your homework number 2, you know that. You have downloaded the data from the website of the US Treasury, and you have seen that the returns on bonds, on the US government bonds, are currently so tiny. They are smaller than the inflation rate. That means that if you invest your money today in the US government bonds, in a year from now, you will be actually able to buy less stuff than you were able to buy today because of the inflation and the small interest rate. And why is that? Because, you know, US government bonds said in 2008, okay, something weird is going on in the markets. We need to motivate people to invest more into markets. And we need to lower down the rate so companies could borrow money at the lower rate. So when they move down the interest rates, they were hoping people will move money from bonds to stocks, because now bonds earn nothing. So why would you invest into bonds when bonds earn nothing? Let's invest into stocks. And this is why they moved the interest rate. You see, they just went down. Zero, almost zero. This is nothing. Now, let's create the histogram from these real historical data. Now, the histogram on the left-hand side is actually data going from 1926 until 2010. This is created from the data that I used to create one of the first charts that I have showed you, from stocks jumping up and down. And here you can see that they very rarely jumped down for 40%, but they often jumped up for like 10 or 20% per year. That was normal. But very rarely you would gain like 50% per year. Now this chart for the bonds is a bit more complicated. It's not just count of the years where you would lose or gain, have this kind of yields, because yields are always positive. So with yields you will always gain something. This thing, the fact that it goes from minus to plus, was created by observing actually the prices of the same type of bonds over time. So you observe a 3-month zero coupon bond of the US government, and one year it costs you 99.8%, in 1 year it costs you 98.7%, and you observe changes in these prices. And you can observe that changes in these prices, if they are plotted on a histogram, they go from minus 0.7% per year to 0.8% per year. You see, this is a completely different scale. There is a huge difference between minus 40% and 50% and minus 0.7% and 0.8%. So if I would plot this thing on this chart, it would actually fit just here in one of these columns. So in a sense, bonds are to stocks what in this lottery example is you have 5 million for sure. These are bonds. And you see, these stocks are spread out. But in order for you to buy then stocks have to offer you much more in terms of return. We still don't know what is the explicit relationship between the risk and the return. But we know that if somebody wants to take on more risk, or in other words, buy stocks, he's expecting to earn more. And we have seen over the time that actually it pays off to invest into stocks. They offer more, but they are more risky. Now, how much more does it pay to invest into stocks? This is what the number called average market risk premium will tell us. So what does the market risk premium telling us? The market risk premium tells us how much more do I earn if I invest in stocks compared to bonds. So for example, Italy on this chart tells you that the market risk premium is 11%. So what does it mean? It means that in Italy, over this period of time, on average, you would earn 11 percentage points more by investing in Italian stocks than by investing in Italian bonds. So for example, if Italian bonds were on average giving you 3%, then Italian stocks on average were giving you 14%. Now, does that mean that it's good to invest, better to invest in Italy than in Denmark? No, it does not. Does it mean that it's better to invest in Denmark than in Italy? No, it does not. It doesn't tell you anything like that. This just tells you in Italy, you will get more by investing in stocks than in bonds than in Denmark. This market risk premium is higher in Italy than in Denmark. So this would imply that there is more risk in Italy than in Denmark, but it's not necessarily neither worse nor better.
So does it refer to the standard deviation?
No.
Concerning the stocks?
This is what we are going to see actually in the next slide. So in the next slide, we observe the standard deviation of stocks in the countries. And we will see that Italy is among the largest ones. And you will see that there is some relationship between the previous slide. The higher risk premium countries are on the left-hand side, the lower risk premium countries are, so here are the lower, on the left-hand side are the lower risk premium countries, and higher risk premium countries are on the right-hand side. But still we cannot say what is better in which country. We need a relationship between the risk and return. But this is what we do in the next class. In this class we measure risk. And we said the measure of risk currently for us is the variance or the standard deviation. So, how do you calculate if you have historical data of investing, let's say, into Italian markets? How do you calculate, or in IBM, how do you calculate the standard deviation of the stock of IBM? You should know that from your statistics class. Why is everybody laughing when I mention statistics class? I hope that your statistics professor will not listen to this online lecture. But okay. So how do you do this? Imagine that these were returns in percents that you would get by investing in, let's say, stock of IBM. Let's say if you invested into the stock of IBM in 2008, you would lose 20% of your money. If you invested in 2009, you would win 10%. In 2010, you would win 10%. And in 2011, you would win 40%. Let's say that these are historical data. So what is the standard deviation of these returns? How do you calculate the standard deviation of these returns? As I said, this is the, first of all, variance is the average squared deviation from the mean. So what is the mean here? What is the mean of these returns? It's 10. It's 40 plus 10 plus 10 minus 20 divided by 4. This is like these two cancel out, so this is 40 divided by 4, this is 10, okay? So what are the deviations from the mean? What is the distance of each of these observations from the number 10? This one is 30 away from 10. This one is 0 away from the 10, because this is 10. This one is 0 away from the 10. What's the distance between 10 and minus 20? It's minus 30. Okay, so we put these numbers to the square. This is 900, 0, 0, 900. You add them together and divide them by 4. This is the average square deviation from the mean. So this is the variance. Variance is 450. And what is the standard deviation? It's just the square root of this. So in this case, this would be 21.2%. Okay? And you know, this tells you how wide this normal distribution is. And this is so simple to calculate. In Excel, you have the function standard deviation. You just give it a series of numbers, and it calculates you the standard deviation, and that's it. Okay, now we know how to calculate the standard deviation of a single stock. We also know how to calculate, we know what is the return of a single stock. This is what we have done in the previous class. Now the question is, how do you calculate the return of a portfolio if you invest in more than one stock? You invest into stock of, let's say, Walmart and stock of IBM. And let's say that you invest 60% of your money into Walmart and 40% into IBM. What is the return that you get from this investment? Well, if the return of Walmart is 10% and return of IBM is 15%, then in total you would earn 0.6. This is the percentage that you have invested in, fraction that you have invested into stock of Walmart, times how much do you get by invested into Walmart, which is 10%, plus fraction that you invest into IBM, times the return that you get from IBM. So you get 12%. What's the idea? Well, 60% of your money will grow at the rate of 10%, 40% of your money will grow at the rate of 15%. So all your money will basically grow at the rate of 12%. You will have 12% more after 1 year. Okay? So this is just the weighted average, nothing more. This is just the weighted average when you're calculating the portfolio return. So if you have two stocks, this is fraction of portfolio in first asset times the rate of return on the first asset plus the fraction of portfolio in the second asset times the rate of return on the second asset. Now, what happens if you are actually investing into 3 stocks? It's very simple. It's just the weighted average. So now you invest into Walmart, IBM, and Microsoft. And this will be 20% that you invest into Walmart times the return of Walmart 10% plus 30% that you invest into IBM plus return of IBM times return of the IBM plus 50% of your money that you have invested into Microsoft times 20% that is return of the Microsoft, and you get to the number of 16.5%. This is how much more you will get if you invest into these 3 companies. So in general, what we can say about the portfolio, if portfolio consists of n companies, 100, and you know, every bank invests into many companies. It's just this W comes from weight. This is portfolio weight. What fraction of your money is invested in a company I times the return of a company I, and you sum over all companies. And you know, sum of all weights must be equal to 1, because 0.1 goes to company number 1, for example, 0.2 goes to company 2, etc. They all together sum up to 1. So sum of WIs is always 1. Okay? These are fractions. Now the question is, how do you calculate the risk of a portfolio? Well, it turns out that this is a bit more complex thing. Why? Imagine that you have a company 1 and company 2, stock 1 and stock 2. Let's say that these are some competitors maybe, that these are Unilever and Procter & Gamble. They produce the detergent. And now imagine you invest into these 2 companies. When one company goes up, let's say sales of Procter & Gamble are going really good, well then Unilever won't be able to sell that well. Why? Because, you know, they are competitors. So their return goes down. So on average, if you invested into these 2 companies, it might be that you didn't earn anything. So in a sense, it depends how these things move together. Now I will give you a recipe how to calculate the risk of a portfolio. So how do you do it? Well, you create a table like this, and in this table it has rows and columns as many stocks. Let's start with 2 first. So you have stock 1, stock 2. So what is the first element in this table? This is the proportion that you invest into company 1 to the square times standard deviation of company 1 to the square. And standard deviation to the square, this is the same thing as variance. Okay, the other diagonal element, so this is the diagonal. This is the first diagonal element. The second diagonal element will be proportion that you invest into stock 2 to the square times the standard deviation of the stock 2 to the square. Now, what are the off-diagonal elements? The off-diagonal elements are there to help you deal with this effect that stocks might move actually together, or they might move in the opposite way. So we have to capture up this phenomena somehow. And this phenomena is captured with these elements of this table. And you see, these off-diagonal elements are the same. This is equal to this, okay? These off-diagonal elements are exactly the same. And what are these off-diagonal elements? These are just proportion invested into company 1 times proportion invested into company 2 times something called correlation coefficient times standard deviation of company 1 times standard deviation of company 2. Now, this correlation coefficient is there to capture the co-movement of stock, whether they move together or they move in the opposite directions. We will see a little bit about that more. I mean, I cannot explain you why this formula is like that. And actually, now if you want to calculate the risk of your portfolio, you would add all these things together. This would be the variance, and square root of it would be the standard deviation. Now we will do examples and try to understand the intuition behind this formula. But I cannot derive with this formula. This is a job of your statistics teacher. This is the standard deviation of the returns. This one thing, this is a covariance. So covariance is the same thing as correlation coefficient times standard deviation 1, standard deviation 2. So sigma 1, 2 is the covariance. And covariance is the same thing as correlation coefficient times standard deviation of company 1 times standard deviation of company 2. Okay. Now let's do one example and let's try to get the intuition behind this formula. Let's try to get the intuition now. Okay? It's exactly the same example. You have Walmart and you have IBM. And 60% of your money goes to Walmart, 40% goes to the IBM stock. Now, let's say that the standard deviation of the Walmart stock is 22%, standard deviation of the IBM stock is 23%, and the correlation coefficient is 0.8. So what happens with this? What is the risk of this portfolio? What is the risk of your investment if you invest 60% of your money into Walmart and 40% of your money into IBM? Let's observe what happens. So I told you, first calculate this element. Proportion invested into company 1 to the square times the standard deviation to the square of company 1. So this is, you invest 0.6 into Walmart, so this is 60% into Walmart to square, times, what is the standard deviation? Is 22%, so 0.22 to the square. This is the first element of this table. The second element of this table is this thing over here. It's proportion that you invest into company 2 to the square times standard deviation of the company 2 to the square. So this will be 0.4 to the square times 0.23 to the square. And now, you see, these two elements are the same. So we can say 2 times this element. So this is the same. This plus this is 2 times this. They are exactly the same. So this will be plus 2 times, let's say this. Proportion that you invest into company 1, this is 60%, times proportion invested into company 2, this is 40%, times correlation coefficient, which in this case is 0.8, times standard deviation of company 1, this is 22%, times standard deviation of company 2, this is 23%. Okay? This is just the mechanics. You calculate. You have a formula, you calculate it. And you get that the variance of this portfolio is 0.0453. Okay? Now, if this is the variance, standard deviation is 21.3%. What do we learn from this example? Observe the numbers. Observe the numbers. First, what is going to be the return of this portfolio? What we know for sure is because 60% of your money grows at a rate of 10%, 40% of your money grows at a rate of 15%, that means that the return of this portfolio will be between 10 and 15%. We can calculate it, but it's enough to know that it's between 10 and 15 for what I want to say. Now, but what is the standard deviation of this portfolio? It actually is smaller than any of these two standard deviations taken apart. So 21.3 is less than 22, is less than 23. So what we can say, that investing into this portfolio is for sure better than investing into stock A only. And we don't need to know about the relationship between risk and return. We don't need the explicit formula that will tell us this risky company should have this kind of risk return. Why? Because you see, it earns more in percents than company than Walmart. So this portfolio will earn more than Walmart in percent. It will be more than 10% because 40% of your money grows at a rate of 15%. But nevertheless, the standard deviation, the risk is smaller than the risk by investing only into Walmart. Okay? Do you see that? Standard deviation of this portfolio is smaller than the standard deviation of Walmart. And nevertheless, it offers you more on average. So you prefer this portfolio to Walmart stock alone. Now, whether you prefer this portfolio to the stock of IBM, this is not so clear, because this portfolio is less risky, but it earns less than stock of IBM. It will earn less than 15%. Okay? Now let's play a little bit with this correlation coefficient. Let's get intuition how the correlation coefficient is influencing the risk of a portfolio. Let's do exactly the same example, but instead of correlation coefficient of 1, let's have the of 0.8, let's have the correlation coefficient of 1. Okay? What happens if the correlation coefficient is 1? Then first two elements are exactly the same. This last element, you change 0.8 for 1, you get a different variance, and you get a different standard deviation. But now standard deviation is going up. So as the correlation goes up, the risk goes up. As more these stocks are correlated, the more risk we get. Now let's observe what happens if the correlation coefficient is actually -1. We do exactly the same thing. First two elements are the same. The last element is changing. It goes to -1. Actually, here it should be 0.016 as here. And you will see that then if the correlation coefficient is -1, then the risk goes, the standard deviation goes just to 4%. It's a tremendous decrease in risk. Now, I mean, as I said, you should have learned about the correlation coefficient in your statistics class, but let's try to understand what is correlation coefficient telling us. What is correlation coefficient telling us? So, these are kind of plots that are there to try to for different values of correlation coefficient from 1 to -1, okay? Now let's observe this example. Let's observe this example over here where I draw this coordinate system. So what does these blue points mean? These blue points mean if on x-axis we have returns of stock 1 and on y-axis we have returns of stock 2. So in this case, when the correlation coefficient is 1, it means if R1, for example, is positive, then we can with certainty say that R2 is going to be positive as well. You see? It doesn't mean correlation coefficient, as you observe, is if you observe in the plot next to it. It doesn't mean that if stock 1 increases by 10%, the stock 2 will increase by 10%. No. As long as they are on a straight line, and this straight line has a positive trend, this will be the correlation coefficient of 1. Now, what does the negative correlation coefficient mean? What does it -1 mean? Well, -1 means if R1 is positive, if the return on stock 1 is positive, then return on stock 2 is negative. If return on stock 1 is negative, return on stock 2 is positive. Okay, this is what correlation coefficient tells us. Now, what does the 0.8 means? Well, it means that if the return on stock 1 is positive, then most likely the return on stock 2 is positive as well, but sometimes it will be negative as well. So we cannot say it with certainty what is going to be the return of stock 2 if we know the return of stock 1. So this is what I told you. How these things are correlated is important. Why? Because if you hold two stocks that move in exactly opposite directions, so in exactly opposite direction, if one earns you 10%, the other loses 10%. That means on average you will not move. You will earn just exactly 0. Then this will remove your risk completely. So negative correlation coefficient goes into the direction of removing risk. So, what we have learned so far, that if you have a portfolio of two stocks, it's easy to calculate the return, and it's just the weighted average between these two returns. If you have, how do you calculate the variance of portfolio? Well, you calculate it given this formula. So what's the standard deviation? You take the square root of this variance. Now, we said if you have portfolio of many stocks, it's easy to calculate the return. The return will be just the weighted average of these returns. You multiply the return of each company with the corresponding proportion of the money that you have invested in your company. And you sum them up. And now we come to the fact, how do you calculate the risk of a portfolio of many stocks? Now, now if you look in your slides, this might look complicated, but it's actually very, very simple. It's very simple, and you will see it now, believe me. So if your portfolio consists of n stocks, if you invest your money into n stocks, you create a table which will be of size n by n. Then in the diagonal, this is very easy. You fill in the elements of the form, proportion of your money that you invest in stock 1 to the square times the standard deviation of the stock 1. The second diagonal element will be just the proportion that you invested into stock 2 times the standard deviation of the stock 2 to the square. Now, the nth diagonal element will be just the proportion that you have invested into stock n to the square times the standard deviation of the stock n to the square. This is just the simple mechanics. You see, there is nothing, you just change indexes. This is proportion in stock 1 to the square times the standard deviation of the stock 1 to the square, proportion of the stock in the stock 2 to the square times the standard deviation of stock 2 to the square, and then in the third one or in the fifth one you would have proportion of your money that you invest into stock 5 to the square times the standard deviation of the stock 5 to the square. Okay, so diagonal elements are very, very straightforward. It's exactly the same like in the case of two stocks. Now these elements of the diagonal elements are also pretty simple. So what is this element going to be? Element in the row 2, column 1. Well, this element is there to capture the co-movement of stock 2 and stock 1. This is why it's in the second row and column 1. And like in the 2 by 2 case, it will just be proportion that you invest in stock 1 times the proportion that you invest into stock 2 times correlation between the stock 1 and stock 2, correlation coefficient between stock 1 and stock 2, times the standard deviation of stock 1 times the standard deviation of stock 2. And this element is exactly the same as this element. So row 2 column 1 is the same as row 1 column 2, okay? Now, what is this element over here? Let's clean these things a little bit. So what is this element over here? Well, this is row 3 column 1. This element is there to capture co-movement of the stock 3 and stock 1. So it will be proportion that you invest into stock 1 times the proportion that you invest into stock 3 times the correlation coefficient between stock 1 and stock 3 times the standard deviation of stock 1 times the standard deviation of stock 3. And this will be exactly the same element as this one over here, which is row 1 column 3. So row 1 column 3 is the same as row 3 column 1. Okay? Now, what is this element over here? So this is row 3 column 2. It should capture the co-movement between stock 2 and stock 3. So it is proportion that you invest into stock 2 times the proportion that you invest into stock 3 times the correlation coefficient between the stock 2 and stock 3 times the standard deviation of stock 2 times the standard deviation of the stock 3. It's as simple as that. You just fill in this table. And you see, element row number 3 column number 2 is the same as row number 2 column number 3. Now, again, you can do it for some nth stock and stock number 3. So for example, this cell over here, this is column number 3, row n. This will be proportion that you invest into stock 3 times the proportion that you invest into stock n times the correlation coefficient between these two stocks times the standard deviation of stock 3 times the standard deviation of stock n. And this will be the same element as the element in the third row and nth column. Now when you fill in this matrix, you add them together, you will get the variance of your portfolio. And the square root of this number would be the standard deviation of your portfolio. And now we know how to calculate return on any portfolio, and we know how to calculate the risk of any portfolio. Now, in the next class, we just need to find out what is the relationship between this risk and return. And this is the Nobel Prize in economics. Markowitz, Sharp, Littner got the Nobel Prize for what we're going to do in the next class. And everybody can understand it. And I believe this is, during your schooling in this school, this will be the only class where you will learn about the Nobel Prize in anything. Maybe you learn about some peace Nobel Prizes or something, but I believe this is the only Nobel.
I have a question about slide 40, I think it is.
Slide 40.
Yes. Could you shortly repeat the conclusion? It was the one with...
This one. So, in this slide, we can observe that the risk of this portfolio, the standard deviation of this portfolio is 21.3%, which is smaller than the risk of any of these stocks taken separately. People pay attention. I mean, question like this was in the exam. Question like this was every year in the exam. I give you a portfolio and I ask you, should you invest into this or that? And then people give some random answers. So pay attention to what I'm saying. Please keep quiet. So what do we conclude from this? We conclude that the risk of this portfolio, of the mix by investing into stock 1 and stock 2, is actually 21.3%. While the risk of investing into company 1 only, into Walmart, is 22%, and in company 3 is 23%. These are standard deviations of their returns, okay? So this portfolio has the lower standard deviation than any of the stocks taken separately. And note that actually return of this portfolio is higher than the return of the first stock, than the return on the stock of Walmart. So you would earn more than you would invest in stock of Walmart with less risk. But if you compare it to the stock of IBM, you would earn less because your return is somewhere between 10 and 15%. You can say that. Because 60% of your money grows at the rate of 10%, 40% grows at the rate of 15%, so you earn something between 10 and 15%. We can calculate how much. But this is something in between 10 and 15%. So you earn more than just by investing into stock 1. But this is even less risky than investing into stock 1. So you strictly prefer this portfolio to stock 1. When you compare it to the investing in only stock 2, you cannot say that. Why? Because you earn less than you would if you invest only in stock 2, because you earn something between 10 and 15%, and stock 2 offers you 15%. And you are less risky than stock 2. So in order to say whether you prefer this portfolio or stock 2, you would have to know something about the relationship between risk and return. But we can say that we strictly prefer this portfolio than stock 1, because it earns more and it has less risk. So there is no doubt that this is better. Any questions, comments, short speeches? Then we are done.